Okay, well, good morning, everyone. Welcome to the Foreign Correspondents Club of Japan here in Marunouchi. I'm Anthony Rowley, a former president of the club, and I shall be acting as moderator today. And welcome also to the latest in what we call, our deep dive events, in which we ask expert panelists to discuss topics of current interest. And today we've chosen to look at what I think obviously is the very topical issue of the yen, which has been doing its own deep dive lately in a plunge that has taken it to the lowest level in 20 years against the dollar and against other currencies. And we're very fortunate to have two prominent panelists here with us this morning to discuss where the yen will go from here, which is obviously a question of key importance for Japanese business and for consumers and investors too. On my left, we have Tohru Sasaki, Managing Director and Head of Japan Markets Research with JPMorgan Chase Bank Tokyo and JPMorgan Securities Japan. And Sasaki-san previously held various senior positions with the Bank of Japan. On my right is Jesper Koll, Expert Director of Japan-based Monex Group, and a former Managing Director and Chief Economist for the US investment banks JPMorgan Japan Securities and Merrill Lynch Japan Securities. Each of our speakers will speak for approximately 15-20 minutes, and then we'll have a Q&A session with those here in the room today and also those who are joining us online. Okay, well, the yen isn't exactly in free fall yet, but the apparent absence of any agreement on concerted international intervention in currency markets. No agreement reached last week during the G20 meeting in Washington, so there's obviously no safety net under the yen. The question I think most people are asking is, will it drop to 130 to the dollar level or below, and what could be the consequences? So I'm going to hand over right away to our experts to analyze the situation, but let me just first say a little bit more first by way of introduction. Sasaki-san, as I said, he will lead off the discussion, is a Managing Director and Head of Japan Markets Research with JPMorgan Chase Bank Tokyo and JPMorgan Securities Japan Company. And prior to joining JPMorgan in April 2003, he held a number of positions with the Bank of Japan, where he worked since 1992. Sasaki-san served as Bank of Japan representative of the Americas in the New York office between 2000 and 2003, where he was responsible for exchanging market information and views with the Federal Reserve Bank of New York and other US financial authorities. He also worked as a senior trader of the foreign exchange division at the BOJ Tokyo office between 1994 and 1997, where his responsibilities included the execution of foreign exchange intervention and the provision of foreign exchange market analysis to senior policymakers. I'll introduce Jesper more fully later, but Sasaki-san, the floor is yours.
Okay, thank you very much, Anthony-san. And thank you very much, Anthony-san, for inviting me this opportunity. And nice to see you again, Jesper-san. We used to work together in JPMorgan, so very happy to see you again. And thank you very much for this opportunity today. I'm very glad to have this speaking here. And actually, I just heard that last time I have this opportunity was in 2007, when the yen was around 124. And probably, if I remember correctly, I was expecting that the dollar yen to go up up to the 130. But actually, that was a peak. 124. So I'm going to speak about the yen weakness in the future, but from the example, previous example, the time when I speak here was the peak of dollar yen. So that's kind of the disclaimer I'm going to speak here. But honestly speaking, the level of 124 and this time 128. Is totally different in real terms. This time, yen is much weaker in real terms. That time, it was not the weak yen. And secondly, the reason why yen was weak in 2007 was totally different reasons. I mean, not totally, but it's very different reasons. At that time, the interest rate gap was very wide. Like I think like RBA, the policy rate was 6%, RBNZ that was probably 7% or something. So the gap was very large. And then in global, the yen carry trade was very active. Everyone in many people in the world used the yen as a funding currency, and then selling the yen against the foreign currency. I still remember that there was some popular financial products which is called the yen mortgage loan. In other countries, the banks borrow yen and then convert it to their own currency, and then got the carry, and then provide the mortgage loan to their people. So basically, at that time, there was a huge amount of the yen short position held by the financial institutions. So probably, if I remember correct, I was telling that at that time, the yen may have a more room for the upside. Yen may be weakened a little bit more, but once something happened, yen will appreciate very sharply. The people will have to buy back yen. And actually, that something was happened in 2008 and 2009, if you remember, as you remember. So, but this time, the weakness of the yen is basically led by the Japanese importers. It's more fundamentals and more structural problem. So, again, I'm going to say, dollar yen may go up to 135. It could be 140. Again, I might be wrong. It could be a peak, but at this time, probably the reason behind the yen weakness is different. So this time, we really have to worry about the yen weakness. At that time, in 2007, I probably didn't say we have to worry about the yen weakness. It's just yen carry trade. And then yen weakness was actually good for the Japanese economy, because at that time, Japan was a trade surplus country. So it was okay. But now there are many things which is against the yen weakness, and we have to worry about this weakness of our currency. And I like to use some of my slides on the page 1. Could you show? On the upper right chart of the page 1 is a yen effective exchange rate, real effective exchange rate. Then now, yes, in nominal base, yen hit the 20 years low against the dollar, but actually in real terms, effective exchange rate is lowest in 50 years, the lowest since 1971. So long time ago. The reason is very simple. In last 20 years, for example, US inflation rate goes up 50% more than that of Japan. But dollar yen is almost the same level. For Japanese, if US inflation rate goes up 50%, the price level of the US is 50% more expensive. That's why yen has to appreciate to adjust that price level. But the adjustment does not happen, which means usually if the US price goes up, US people should come to Japan, because everything in Japan is cheap, but they don't come to Japan to buy Japanese yen or invest in Japan. So that's why adjustment does not happen. This is structural problem of the currency market. And even dollar yen on the right bottom chart, maybe it's a bit difficult to see, but basically what we can say is that the divergence, deviation from the fair value of dollar yen is the largest since 1971. So not just on the yen effective exchange rate, dollar yen is also the highest in 50 years in real terms. So that's the problem in Japan right now. On the second page, the reason why this is happening is very simple. It's because of the capital flight by Japanese corporate. As I show the upper right chart, that's foreign direct investment by Japanese corporate. Since 2013, Japanese foreign direct investment has started increasing very rapidly, very sharply. For example, in the past 9 years, the average level of the average amount of the foreign direct investment per year is 15 trillion yen, 15.0 trillion yen. But the previous 9 years average is 6.8 trillion yen. So more than half. Since the 2013 is a kind of first year of the Abenomics, maybe it's easy to say that under the Abenomics, the Japanese corporate got out of the country. But I think the causation is a bit different. I think the reason why Japanese companies start increasing their foreign direct investment starting from the 2013 is because of the earthquake. Partly because, mainly because of the earthquake in 2011. Since that earthquake, probably many Japanese corporates start changing their supply chain. Also, after that, the protectionism and environmental regulations is causing that the US or the European countries asking their manufacturers to produce products in their country, so the Japanese corporate cannot come back. For example, now the Japanese, I'll explain later, but the average annual salary in Japan is half of that of the US. So the Japanese corporate manufacturers should come back to Japan and produce their products and export. That's much profitable, but they don't come back. It's mainly because maybe the supply chain change after the earthquake, or protectionism, or environmental regulation, or many political reasons. Maybe they cannot expect that Japan as a big market, so that's why they don't come back. That could be a reason. But anyway, just foreign direct investment keep increasing. Japanese corporate go out, and then as a result, even the yen gets weaker. On the bottom chart, Japan's trade surplus does not increase. It's very clear. It's just simple trade balance chart on the bottom chart. It's very simple, right? But if you see the difference until 2010 and after, it's totally different. Before 2010, we have a huge amount of the trade surplus. But since then, we cannot record the trade surplus, mainly because many Japanese corporates got outside of the country. And then now, Japanese current account surplus is still huge, 3% of GDP. But I would say, almost all the current account surplus is income surplus. Income surplus means that return from the investment. But now, as you can see on the upper right chart, Japanese corporates are investing abroad. They expand their investment abroad. So even they got the return from the outside foreign business, they reinvest in overseas. And then portfolio investors, they got the return, like a coupon or income from the bond. But Japan's yield is zero. So there's no reason to bring back money home. So although the income surplus is very big, most of this income surplus is reinvested in foreign countries. So basically, there's no people, no flows coming into Japan. So that's why yen just keep going lower. Again, yen is very cheap, super cheap right now, but no one outside of the country try to utilize this cheapness. That's the situation. And on the page 3, this is showing the Japanese imports and the commodity price. For example, upper left chart, orange line is showing the amount of the imports, and the gray line is showing that the commodity price. As you can see, left side of the chart, Japanese import amount has a very good correlation with the commodity price. So commodity price goes up, Japanese import increase. Commodity price goes down, Japanese import decrease. It's very simple. But since the middle of this chart, on the right side of the chart, the correlation has lost. even commodity price keep declining, Japanese import stay at a certain level. The turning point was 2011 earthquake. So from that chart, we can tell the Japanese trade structure has changed since 2011. Many Japanese corporate went outside, and then start producing the products and start importing. On the right side of the table, it is showing the detail. Basically, what we can say is that Japanese increased import of the electrical machinery from Asia, and then electrical machinery, chemical, auto from Europe. Some people may say that, since that point, Japanese increased the energy import because of the shutdown of the nuclear power plant. But actually, it's not. Japan's import of energy did not increase much. The reason why trade balance has deteriorated is because of electrical machinery import from Asia and Europe, and then chemical and auto from Europe. It is obviously showing that Japanese went out the country and then start producing the products outside the country. And as you can see on the left side of the chart, green line is trade balance, and the blue line is the yen effective exchange rate. Below, going downside of this chart is showing that the increased trade deficit and weak yen. So from here, we can expect that much wider trade deficit because of the higher commodity price. We will expect that weak yen. It's because of the change of the structure of the trade. Japanese economy has changed. The structure of the Japanese economy has changed, and the import increase. So it's easy to record the trade deficit. And that situation, commodity price start going up. So we are facing some difficulty, the difficult situation. And then please go to page 4. This is showing the wage level. Maybe it's a bit too small, but if I can say, in 2000, Japanese annual average level was the third largest among the OECD countries. Japan was kind of a rich country, but now 20th. It's because other countries' wage is keep going up. Japan stay. Japanese average wage is 4.4 million yen in the past 30 years. No change. 4.4 million yen. So in 2000, 4.4 million yen. Actually, red bar chart is Japan. 4.4 million yen was the third largest. The largest wage was 5 trillion yen of Switzerland. But in 2020, it's still same 4.4 trillion yen, 4.4 million yen in red, but it's 20th. The highest wage is, again, Switzerland. It's like 11 million yen, because their currency, the wage is going up, and the yen weakened. That's why the other countries' wage is just keep going up. So maybe in yen term, Japanese can understand easily, but for the outs and the foreign people, it's maybe easy to understand in dollar term or euro term. For example, in US, the average annual average wage right now is 69,000 per year. That's the average. In Japan, in dollar term, 34K. It's half, actually less than half. And in Germany, average wage is 43K euro, 43,000 euro. But in euro term, Japanese wage is 32,000 euro. So because of the weak yen and then unchanged wage, Japanese wage level becomes very low. And Japan used to be a rich country, but not now. As I wrote here, Japan, 1 out of 7 kids are in a relative poverty level, and half of single-parent families are in relative poverty. a family with one parent and one child lives with less than $14,000. So under that situation, if oil price keep going up, gas price, food price going up, and the yen weaken, those kind of people will face a significant difficulty in coming months or year. So the weekend can be good for the Japanese country as a whole because we have lots of assets outside the country. But if we think about those kind of people, this weekend and the higher commodity price is actually very, very dangerous situation. And page 5, this is a commodity price in yen. Oil price, wheat, aluminum, soybeans. Almost all those kind of a major commodity price in yen is now historical high level. And then on the page 6, actually Japan's PPI is going higher, 9.5% over year in March 2022. It's at the highest level since 1981. So in corporate level, we are seeing that higher inflation, but it doesn't feed to the consumer price because Japanese corporate is absorbing this cost pressure. But as you can see on the upper right chart, the blue line is showing that the difference between PPI and the CPI in Japan. This price gap has never seen since the oil shock. So I'm not sure how long Japanese corporate can survive or sustain this kind of gap and absorb the cost. And then bottom right chart is showing that the annual increase in CPI.
Forgive my ignorant interruption, but PPI is what? PPI is
Producer Price Index.
Purchasing Price.
Producer Price Index.
Sorry.
Sorry. And then also the annual increase in CPI on the bottom right chart. It's the developed country, excluding Japan, is now reaching 6.8% over euro. We have data since 91, but never see that kind of a high level of the CPI in global. Japan is not living isolated from the other countries. Japan imports many products from the other countries. And the other countries' average inflation rate is 6.8% right now. So Japanese corporate cannot continue to absorb this kind of the cost up. So eventually, I think inflation will come into Japan. And then, maybe I will skip to the page 8, about the intervention. Japanese government actually likes to intervene to the market, like a JGB currency market. And then when I was in BOJ, Japan did lots of yen selling intervention. But the yen buying intervention is totally different from the yen selling intervention. Yen selling intervention try to support the dollar yen is easy because the government just easily finance the yen by issuing the bills. But yen buying intervention, basically we have to sell the foreign reserve. So once foreign reserve start decreasing, and then dollar yen cannot stop going up, that's going to be a risky situation. Market starts watching that kind of development and then starts speculating that Japanese currency keep falling down. Some people may say that, oh, we still have 150 trillion yen of the foreign reserve. That's big. Yeah, actually, it's the second largest foreign reserve, I think, 150 trillion yen of the foreign reserve. But at the same time, Japanese household deposit is 1,000 trillion yen. So once the Japanese household start capital flight, 150 trillion yen of the foreign reserve is so small. And then people have been, I mean, including me, have been saying that someday the Japanese household will start capital flights, but never happened before. But it was easy. It was because it's not so easy to buy the foreign currency for the Japanese. I think until 10 years ago, if you really want to buy foreign currency, have a foreign deposit, you have to go to bank during the daytime. But now you don't really have to go to the bank. You can use a smartphone. And now Japanese people start feeling that we are no longer the rich people, rich country. We are losing their purchasing power. So once the Japanese people start thinking that yen is losing purchasing power, everything is expensive overseas, and then energy price keep going higher. Okay, let's use the smartphone and buy foreign currency. It's very easy. So 1,000 trillion yen, if 1,000 trillion yen starts moving outside the country, it's very difficult to stop the yen weakness. So basically, I'm not predicting that will happen, but I'm worrying about this situation right now in Japan. So I'd like to stop here.
Okay, thank you very much indeed, Sasaki-san. Very interesting. You said this time we need to worry about the weak yen, and you certainly justified that with your explanations of structural changes. Okay, let's turn to Jesper, who, as I said, is a managing director and chief economist, or was managing director and chief economist for the US investment banks JPMorgan Japan Securities and Merrill Lynch Japan Securities. He's an expert director at Japan-based Monex Group, an investment committee member of the Japan Catalyst Fund, and he serves on the board of directors of OIST, the Okinawa Institute for Science and Technology. He worked finally from 1985 as a research fellow at the University of Tokyo and the University of Kyoto before he went on to build his career in finance. So, Jesper, please.
Great, fantastic, and thank you very much. And Sasaki-san, it was always a pleasure working with you, and there's such succinct insights into what's been going on here. And I thought, you told it all. And I think you're right. I was taught once by one of the great speculators in the world. He goes, Jesper, markets go in the direction of maximum pain. And I think that, the point of real probability of a parabolic move in the Japanese currency, and whether that takes us to 140 or whether that takes us to 150, a speculative overshoot right now is indeed very, very likely. And Sasaki-san pointed out sort of the deep economics. And it's very interesting when you listen to that, and particularly interesting, I think, is the fact that the trade balance of Japan, the overall balance of payments, has actually changed in exactly the way that the Americans demanded of Japan throughout the 1990s. Because it was the deindustrialization, it was the hollowing out, it was the increasing offshoring by Japanese corporations that took place throughout the 1990s and, in the early 21st century. And the benefits from that, as it were, are now coming through because, as Sasaki-san pointed out, you've got the reason for the trade balance deteriorating right now, yes, is the high commodity prices, but more structurally, it is the fact that you've got final goods, particularly electronic goods, being imported back from the Japanese offshore factories that were set up. That's a structural change which was demanded from the United States onto Japan at the time, but now you actually have the reality, and as a result of that, you start to have a growing divergence between, who benefits from yen depreciation and who gets hurt from yen depreciation. And which is to say that actually the negative impact, the cost push impact for the Japanese consumer has actually gone up. It used to be confined to just commodity and food, while actually now it is much broader because of the Japanese corporations themselves arbitraging final products back into Japan. So that's quite interesting. That's a structural change there. Now, as an investor, right now, I am prepared, to speculate, to invest on a parabolic move in the Japanese yen. And I want to give you just a couple of the reasons for why that is, focusing a little bit on the things away from Japan, focusing on the United States of America as well as on China. Because it's actually interesting. The dollar yen actually was uncharacteristically stable, right, over the previous almost 5 years. We were basically in a 105 to 110 box that was relatively stable. Very uncharacteristic to compare to what we went through over our career. But getting out of that 105, 110 range to the 125, 130 levels that we're at today, there's no mystery. It's actually very straightforward. It is the divergence of monetary policy, with the Federal Reserve saying, we've got to step on the brakes, we're going to raise interest rates, we're going to cut down quantitative easing, while Bank of Japan Governor Kuroda says, no, we are not. Deflation is still a big concern here. I don't want to tighten too early. No reason to Federal Reserve. And you can see every time the Bank of Japan intervenes in government bond markets, buying JGBs to prevent an increase in Japanese interest rates, every time the Bank of Japan does that, the yen moves down by 2 or 3 ticks. Show me the money. The Bank of Japan is not just talking about decoupling, it's actually acting. And that's what markets want to see, show me the money. Now, it's interesting to see that, in my opinion, you actually have right now a united policy establishment in the United States versus a still relatively disunited policy establishment here in Japan. Because I think if you ask people, is the weak yen good or bad for Japan, you still get 2 or 3 answers, right, depending on whom you're asking. While I think in the United States, it is very, very clear that the number one issue is inflation. The fact that you've got consumer price inflation, accelerating still, to levels of close to 9% and possibly even going higher. The fact that President Biden's popularity rating is deteriorating, with inflation being cited as the number one concern. As a result of that, the United States policy establishment is actually united. They do attack inflation. And of course, if your primary goal is to attack inflation, a weak dollar, not a weak dollar, I'm sorry, exactly the opposite. A strong dollar policy is exactly what you want, because at the margin, that reduces import prices. So it's quite interesting, I think, and in my opinion, we're still quite a ways off for the Japanese policy establishment to actually reach consensus, right? That indeed, inflation is here to stay. Now, personally, as an economist, I think Governor Kuroda is right in the sense of that the inflationary increases that we've seen over the last 6-7 months in Japan are dominated by cost push inflation. There's really almost no evidence of demand pull inflation. And, you can show the reality is most economists now expect that the most recent quarter of growth in Japan was actually negative, right? Another contraction. We've got real wages now falling. And as a result of that, I think that there is still, reasons to be cautious about whether the domestic economy, whether domestic demand is actually at a self-sustaining takeoff point. Because I think we've seen in the United States of America, in contrast, that domestic demand is actually at a self-sustaining takeoff point where we see continued positive surprises on overall economic growth, in particular on consumer spending in the United States of America. The other thing, of course, is that, from a political economy perspective, we got to remind ourselves who will be hurt the most if and when Japanese interest rates go up. Well, that's actually the people's finance. because the government debt level is give or take 2.5 times national income, an increase in the cost of borrowing, an increase in the cost of finance, right, will limit fiscal flexibility. That's when when interest rates increase. And then, of course, if the Bank of Japan were to step on the brakes too early, then you would fall back into recession, and then you have a worse fiscal situation than you actually came into before. So I think, you know, it's quite prudent actually from Governor Kuroda to sort of say, fine, we can tolerate a little bit of higher inflation here in Japan, right? Because the risk reward is still tilted, you know, towards higher risk there. Now, I think that, you know, the key point is, you know, the key question is, you know, what will turn this trend, right? So we've got the economic fundamentals as outlined by Sasaki-san. You know, we've got this policy divergence where for the time being, it's the right bet to assume that the Fed will step on the brakes harder than while Japan is still waiting to build a policy consensus. The question is, what will stop the decline of the yen? And I think there are three fundamental issues. The first one is anybody going to accuse Japan of starting a currency war, right? The second one is a US recession, right? And the third one is Japanese beginning to buy Japan. So let's go through this in very quick order. Currency wars. You remember the last time dollar-yen went towards 140, 142 was in 1998. And it was actually the People's Republic of China that complained about yen depreciation. And it was the United States of America that agreed to publicly call an end to the strong dollar policy. Now, this was a time when US-China relations were very different. The focus was all about bringing China into the WTO. China's complaint that we are competitors in some products with Japan, yen depreciation hurts, you know, the ability of Chinese exports to compete globally, and America actually listened, you know, to this at this point, and that is what sparked, I think, the last round, right, of intervention. And just, you know, by reference, and you know, I lost a lot of money that day. A dollar-yen went from 142 to 111 within 6 hours. So if and when there is policy action, it can be extremely painful. You know, so that's just something that one does need to always be a little bit mindful of. But the key point is that obviously 2022 is not 1998. US-China relations, you know, are in a completely different vein right now. And I think even if China were to complain, I don't think it would get much of a listening, you know, in Washington. Having said that, there's a very interesting development that happened just a couple of days ago when Treasury Secretary Janet Yellen, when she said, oh, maybe it's time to think about negotiating a reduction in the tariffs we impose on the People's Republic of China's exports to America. This is very interesting, because you got to remember, if I'm right, and America is united, we got to bring down inflation. How are we going to do that? Actually beginning to negotiate easier terms for imports from China is very, very important. And just as a reminder, we are here in Tokyo. We always think Tokyo is the greatest thing since sliced bread. Americans paid $450 billion for Chinese imports last year. They paid $140 billion for imports from Japan. So, you know, if you actually negotiated, right, a reduction in tariffs, you know, that would be very, very impactful in terms of almost immediately beginning to impact, you know, Chinese prices. And that takes you to the next level. Is it possible that America will actually agree to a devaluation of the renminbi? right? Is there going to be sort of a reverse Plaza Accord? Because again, if you could actually reduce the imported inflation, the price of imported goods from China, that would obviously immediately have a positive impact, on reducing inflation in the United States of America. It's a long shot, because we're all ensnared in this new Cold War rhetoric that's going on there. But I think you should never underestimate America's ability to be economically pragmatic. And it would certainly be the pragmatic thing. And you got to remember, if the reports from China are correct, China is at the risk of disinflation, of deflation. The economy is slowing down. So from their perspective, a renminbi devaluation would actually be quite positive in the sense of that it would stimulate the tradable goods and export sector in that economy. So that's sort of a risk. Watch that space very carefully for a potential change. If the renminbi, if America were to tacitly agree to a renminbi devaluation, well, that would probably mean that that the yen is going to be depreciating even further. So, it doesn't stop the yen from appreciation, but I think in the currency world, watch the US-China space very, very carefully. The second thing I said that would bring a reversal in the depreciation trend is a US recession. And look, we mentioned that right now in the flight of inflation, a strong dollar is in America's interest because it reduces imported inflation. But it also cuts down US corporate profits. Because you got to remember, of American listed companies, basically between 40 and 45% of earnings come from global sales. That's particularly true for the tech companies. So actually, a strong dollar reduces profitability in the United States of America. And, there is a very interesting, conundrum here, because the combination of falling US profits together with increasing interest rates, that's a recipe for a crash on Wall Street. And I don't think ever in economic history have we seen a time of falling US earnings coupled with rising US interest rates when we didn't have a crash or at least a prolonged bear market in the United States of America, right? So that's, I think, the transmission mechanism. And I do continue to believe that nothing focuses American policymakers' minds as much as a crash on Wall Street. So, what could lead and what could trigger an end of the strong dollar policy? It would be, a demise or stagnation, on Wall Street, going forward. Now, the final point, that could bring about a reversal is exactly, look, who buys Japan? Why do the Japanese not buy Japan? Japanese corporations continue their offshoring rather than onshoring. The Japanese government had to give massive supports to get TSMC to build a semiconductor factory here in Japan. So this arbitrage of Japan having low wages, having low real estate values, having, actually very valuable, and cheap corporations that global companies could buy, that arbitrage of capital just simply isn't happening. And the key for that to happen, in my opinion, is not about global investors, global companies buying Japanese companies. It is whether Japanese companies actually begin to invest in their own country. And I will give you an example. It didn't work out in the end, but when Koizumi became prime minister, there were similar sort of issues. But Koizumi and his team actually persuaded Canon Corporation, Mitarai-san, right, to build a new factory here in Yokohama. And that was a big symbolic move, right, that, hey, something is changing. The Japanese themselves are buying their own country. If and when that happens, dollar yen weakness is going to start to reverse. It's very interesting. Remember at the flip side of things, right? When we had the yen-daka crisis, right? After Fukushima at the beginning of the Abe administration, right? It was actually a public announcement by the world's largest pension fund, the Japanese GPIF, that, hey, we will change our asset allocation. We're going from 12% or something like that of foreign assets to 25%, and we're going to increase our domestic equity allocation from 11% to 25%. That's when the world got excited about, yes, something is actually happening in Japan. So now, ironically, we would need the opposite. And I don't know, Sasaki-san, whether you agree, maybe a big indirect way of intervention would be if the GPIF were to announce that they are going to begin to reduce their US Treasury holdings. That would certainly send a big signal, right, to global markets that, hey, the big whale, a big domestic Japanese institutional investor, is actually no longer interested in buying dollar assets, but is actually beginning to focus on Japanese assets. Should you do that? In my personal opinion, absolutely. When you look at all asset markets in Japan, you find that they're incredibly attractive. Just one data point here, if you look at Japanese equities, you find that they are trading on a price-earnings multiple of around 12 times, while US equities are trading at a price-earnings multiple of around 20, 21 times. So it's very, very clear where the value is. Can you actually unlock the value? Can you participate in the value? That's, I think, the more interesting question. One final point, and I conclude there, which is that, at the end of the day, one thing I'm monitoring very carefully as a potential risk factor is actually if and when Japan opens the country for tourism again. Tourist spending, at the peak was give or take, 5 to 6 trillion yen, slightly more than 1% of GDP per annum. That obviously was squished down to basically nothing, because of the COVID entry restrictions. If and when the COVID entry restrictions do get freed up, at least incrementally, you can forecast a significant, incremental demand, for yen beginning to come through from tourists. And it's interesting, as Sasaki-san points out, Japan is very cheap. I was in the United States a couple of weeks ago. A Big Mac is $5.30 in Los Angeles. It is 399 yen here in Japan. So, fair value, would be at around 75 yen. So that's sort of where we are. Again, in conclusion, I think that a parabolic speculative move towards 145, 150 is very much in the card because of the lack of consensus here in Japan on what to do about monetary policy, while the United States is very, very united in wanting in attacking inflation by all means, including stepping more aggressively on the interest rate bridge. What will switch it, would be primarily, I think, a change in economic fortunes in the United States of America, with a crash on Wall Street being a big red flag, that you would actually have. Final. It's obviously nice to argue about the extreme cases, right? Oh, US falls in recession, then everything changed, we start a new cycle. That's kind of obvious. There are serious forecasters who are predicting that we will enter a period of long stagnation. And long stagnation means what? It means that inflation stays high, but it doesn't accelerate anymore, right? So maybe 5, 6, 7% inflation. But you've got economic growth in the United States that is, nothing exciting. You've got nothing exciting on earnings. If America were to enter a period of stagnation where Wall Street goes sideways, the economy goes sideways, US asset prices go sideways, what would happen then? Then I think there is actually a risk that in America will get the next wave of protectionist pressure. Because from a political perspective, particularly in the run-up to the 2024 election, if this stagnation scenario were to unfold, it's going to become very, very tempting for politicians to blame cheap imports from Mexico, cheap imports from China, cheap imports from Japan, right, for the lack of a feel-good factor in the United States of America. That's further out. Let's hope that we're not going to get there. The more dramatic scenarios, certainly for a foreign exchange speculator, are always better because they've got higher volatility. Thank you very much.
Terrific. Very dynamic stuff. I just hope that Finance Minister Suzuki and BOJ Governor and perhaps even Mr. Kishida, the Prime Minister, have been listening in this morning. Okay, well, we'll open the floor to questions now, starting with the people here in the room, if you have questions, or if not, online. So do we have any questions in the room, please? Do we have any online questions? No, we don't. Well, okay, let me get the ball rolling then by saying... Sorry? I beg your pardon?
Not one question, 100 questions.
Ah.
Well, please ask just one of them. Okay, well, the structural problems that we've heard a lot about are going to be here for a long time, but we have the more immediate problems. So I'd like to ask both of you, if you want. Supposing the present situation continues, the interest rate differentials continue to widen, the yen continues to weaken, perhaps to even to 150, as Jesper has said, parabolic. Where will the problems begin to bite most strongly here in Japan? Will it be in terms of inflation? Will it be in terms of what? I mean, so where will the most immediate problems come if the present situation continues?
I think the consumers, especially the low-income family, who are suffering the higher prices, energy price, and electrical price is already going up in Japan, and the food price is also going up. So the households will hit the immediately. Actually, already hit, and then next maybe the people who wants to go abroad for the sightseeing. They at this moment, not many people are trying to go out for the sightseeing. But once they start feeling, okay, let's go outside the country, they will find that it's very difficult. Everything is expensive right now. So I think first consumer, basically consumers, from the low-income household to the middle-income household. And then, eventually everyone in the consumers will start suffering.
Look, I think that it will be unfolding very similarly to the way it has actually unfolded in the United States. The transmission mechanism into rising inflation is here. It is primarily, unfortunately, a cost push development here. But the gap between those who get hurt and those who don't really get hurt, so let's call it the gap between the rich and the poor, that's going to start to create a political feedback loop. And if it's right, most economists, I don't know about you guys right now, but it's quite likely, statistically speaking, that by April, May, right, we could have CPI inflation between 1.5% and 2%. Actually close to the Bank of Japan's target, right? And I think that will, given that the Bank of Japan's stated inflation target is 2%, that will start to lead to an acceleration of the debate. We've got an upper house election in July. Now it's an upper house, but it still is going to be an important test, for Kishida's leadership. And I certainly do expect that by July, if this 2% handle CPI in Japan does come through, I do expect that the debate is going to become a little bit more vigorous. Now, interestingly, as I said, I'm with Kuroda. I think that, the evidence of demand actually giving price power to corporations, just still isn't there. And I think that Kishida was absolutely right in insisting on corporations to pay, higher wages. Because the absurd thing, I mean, if you think about, my God, here is Japan, and you've got a corporate sector that has got record high cash balances, right? Almost 1 times of GDP, right? The Naiburyuho, right? Retained earnings. They keep on hoarding cash. If there is such a thing as Japan's stakeholder capitalism, this is exactly the time to deploy this, either by not hiking prices and cutting into your retained earnings, foregoing profits, or by actually redistributing the retained earnings into higher purchasing power for the people. But as we know, that's like pulling teeth, here in Japan. So politically, I think that, the landscape in Japan will change, from the summer onwards. I think that the inflation debate is going to become more active. And then, of course, we've got the bonus. We've got the bonus in the sense of Governor Kuroda's second term is expiring at the beginning of next year. So the next central bank governor will have to be appointed. It will probably happen, once the budget is done in seriousness. So at the very end of this year, beginning of next year. And it'll be interesting to see, what type of personality, Prime Minister Kishida is going to be picking at the time. Particularly, is it going to be somebody who's going to become more hawkish, right, on the need to actually change Japanese monetary policy. That's still 6 to 8 months away. So again, I want to underscore as a speculator, as an investor, for the next 4 to 6 months, the parabolic move is the more likely scenario.
Yeah. This problem of capital flowing out of Japan and not flowing back into Japan is obviously a very serious one. And Jesper, you raised the point about the GPIF. I've just been writing on Japanese insurance companies that are furiously buying foreign bonds and stepping up their allocation to buying foreign bonds. So it doesn't look as though that situation of capital outflows and lack of capital inflows is going to change anytime soon. So what could change that? You said Japan has to buy Japan, as it were. But that seems to be not happening. So from that point of view, is the government, are the policymakers sufficiently well aware of these problems, do you think, to be able to make policy interventions that could change the situation?
I think it's difficult to say, but I think the Japanese government right now does not feel like an immediate risk this moment, and then probably don't understand exactly what is the problem. And then, but once the parabolic movement of the yen weakness, probably the government will realize that something wrong is going on. So, for Japanese, I think Japan has to change, as you mentioned, but it's unlikely. But if something really bad happens, people will realize that, oh, this is something wrong. And then eventually Japan can change. So I think this parabolic move of the yen is bad in near term, but in longer term, it could be good for the Japanese economic structure.
So we are looking for a parabolic move. We're not expecting Bank of Japan intervention or Ministry of Finance intervention. We're expecting the yen to go.
Look, I mean, for intervention, you need the agreement from the U.S.
Yes.
And like I said, I mean, that's again, I mean, you go to Washington, it's like they're dead set. This is like, the Democrats will crash and burn if they don't get inflation down. I mean, that's just, that's where everything is aligned here. But to your point about, and this is the key issue, to the point about who will buy Japan, right? And, so this, first of all, will the foreigner buy Japan, right? The foreigner will buy Japan. I mean, if really you can make the case that, look, Wall Street is overvalued. You know, they're going to make a policy mistake. They're going to hike rates too fast, right? Wall Street crashes. You know, you will find value investors like Warren Buffett, for example. He's always the big guy, right? You will find value investors beginning to buy Japanese assets. That's going to happen. But that's not a big move, right? Because the mainstream investors, right? Are, basically, I mean, we're in this period of Japan passing, right? I mean, Japan doesn't matter very much. Maybe there are better opportunities elsewhere. And unfortunately, Japanese government policy over the last couple of years has made it harder, to actually invest and engage in Japan. And what I'm talking about here is the tightening of the gaitameho, the fact that national economic security is now a very, very big thing. So every time you buy more than 1% stake in a Japanese company, you have to get pre-approval, right? If you want to do something, with the company in terms of an activist and engaged type of measure. So from that perspective, I think, global investors buying Japan, yes, the value proposition is there. But much more importantly, the value proposition is there, but the marginal regulatory framework, unfortunately, has gone the other way, discouraging or at least increasing the cost of doing business, of investing here in Japanese companies. So that gets you to the second point, which is, will you actually get a pro-growth policy here in Japan? Right? And it's interesting, right? And just to be critical of Prime Minister Kishida for 30 seconds, right? What is your economic policy? Oh, it's Shingata Nihon Shugi. It's the new style of capitalism. Okay, well, what is that? Well, we don't know. We've got committees that are working on it. That's not why I am investing in a company, right? Or not in a company or in a country. I need an economic policy that actually says, here are the 3 or 4 things that we're going to do to get economic growth going. I don't need promises of debate and promises of a 1,000-page report. And so from that perspective, I think, and I think that the Japanese investors, right, it's easy to criticize, oh my God, why are the Japanese institutional investors just shipping their stuff overseas? Why is it that Japanese corporations are just investing overseas rather than investing here in Japan? It is because the regulatory and ultimately political framework for doing business here needs to be freed up. There needs to be a koizumi. There needs to be a deregulation campaign so that you do actually get global capital and, more importantly, Japanese capital committing risk money here into Japan. There is value, but there's no political will. And that political will needs to change. When that happens, then we're going to be able to see a strong yen again, and a strong yen for the right reasons, because Japan is actually a stronger country.
A new koizumi comeback. The point you raised about... Yes, you have a question? Sorry, I beg your pardon. Please, go ahead.
My name is Kurt Sieber. I'm an associate member. Mr. Sasaki pointed out this fantastic, data I think is the right word. But in the data, you have 2 factors. One factor is, as you pointed out, for the last 15 years, Japanese people have not got any increase of income. So that is one of the key points. The other key point is how many Japanese people are here. And nobody is willing to talk about that. When I came to Japan, and that's quite a few years, decades ago, Japan had 2.4 million new baby births, number 2.4 million per year. today the government is really very, very careful not to mention any of these figures. At least I haven't seen any. But for 2021, it's probably been 800,000. That is about 1/3. And so unless we get the people, the position of the people is important, because they are the ones who ultimately have to buy, and they are now being really restricted in buying. In that sense, I mean, I have a more positive view of of Prime Minister Kishida, because I think during the last 10 years, he is the first Prime Minister who is working for Japan and not for Nippon Kaigi. We should know, of course, that from the political side, the Nippon Kaigi is making every very big effort to get Kishida out again as quickly as possible, because he doesn't fit their idea. But there is one positive part in it. That's the election, the by-election which took place on last Sunday, which gives a good, hope for the upper house elections, and in July, that perhaps the new type of capitalism is having some legs behind or below. And so what are your comments on all that? Thank you.
Got all those points.
Either one of you.
Sasaki-san.
Sorry.
Well,
Look, I love your fact about, sort of, because at the end of the day, it's like, okay, when does Japan start to buy Japan, right? It's the same thing. When will Japan start to have sex again? I'm sorry. When will Japan start to have babies again? Right? I mean, that's the ultimate investment. That's the ultimate, sort of show of confidence, that you actually have there. Whether Prime Minister Kishida, is the right man or the wrong man, for the job, I don't know. I've got my personal preferences, but that's besides the point. I think the key issue is that the decision process, right, has been a democratic one. And for my choice, right, I think, and this goes back to the debate we are focusing on, the debate on what should monetary policy be is very nibbly. It's not a tough, it's not a dialectics. There's no division inside the LDP, at least not an outspoken division about what should happen, right? And there should be one, because I think Sasaki-san and myself are not the only ones. Anybody who looks at the data, who looks at the facts, sees how much the structure of Japan's economy has actually changed, that actually now there is a genuine risk of capital flight. And I think Sasaki-san was always brilliant. For the last 30 years, you were basically always strong yen, and the fundamental argument that was that despite all the differences in growth and interest rate differentials, at the end of the day, the home currency preference for Japan was a very, very high one. And this has changed. This has changed. And so this demands a very, very fundamental debate, because there are measures that need to be put into place to actually begin to correct that, and to encourage and to engender that indeed the home currency preference here in Japan, the will of of the world's largest creditor country, which is what Japan still is, to actually commit risk capital here into Japan. And it needs to come from action led by politicians, and not from debate and discussion. Action.
Do you want to add anything to those points? No, you don't. Are there any other questions in here? No. Okay, well, how much solidity is there within the Bank of Japan board, do you think? I mean, is there any risk that, or risk is probably the wrong word, that there could be a revolt within the Bank of Japan over policy? I'd like to ask you that particularly.
So basically, the foreign exchange policy is not the BOJ's policy. BOJ is not in charge of the foreign exchange policy. So
no, I was thinking more of interest rates.
So but in terms of the interest rate, Japan does not see the actual high inflation yet in the CPI. It's still difficult to see that the higher inflation. So I think it's still reasonable for the BOJ to sustain the current monetary policy. But I personally think that the YCC, yield curve control, is very unnatural policy. As I mentioned, that the Japan likes to intervene to the control of the market. I think it's not good, both in foreign currency and JGB market, because Japan has a huge fiscal debt. So the JGB market is very important. And if we have some kind of artificial control on that market, we may hit some kind of a negative repercussion later. So I think it's not good. So I think first we need to have the free movement of the JGB market. But anyway, the monetary policy, in terms of the monetary policy, eventually we will see, I think we will see that there are higher inflation because of the higher inflation in overseas. And then once we got the cost push inflation, how the BOJ can tackle this kind of problem is going to be the issue. There's some personal change is scheduled in coming months toward the next year. So as Jesper mentioned, that because of the change of the personnel, I think that the BOJ's stance will gradually change. So we may see some kind of a different reaction from the BOJ.
And Anthony, I mean, this is the key issue, right? And it ties into the previous discussion, and it actually explains why the factor arbitrage doesn't happen. I mean, it's very easy to demonstrate that Japan is cheap, both in absolute terms as well as in relative terms, right? But this arbitrage, right, whether it's capital, whether it's labor, whether it's financial assets, doesn't happen precisely because at the core of the Japanese financial structure, we've got the Bank of Japan conducting an unprecedented experiment in financial socialism. I mean, this is a central bank, right? This is a central bank that owns, give or take, 50% of the government debt market. This is a central bank that owns, the vast majority of corporate debt. And this is a central bank that owns 10% of the Japanese equity market, right? This is an unbelievable construct. It's kind of like, I sometimes joke, it's like Brezhnev's wet dream. I mean, it really is, this is not a free market economy. And at the end of the day, as Sasaki-san points out, if you restrict the price of a 10-year bond, that is the risk-free reference rate for all other asset allocation decisions that you make. If that bond yield is not allowed to move according to what the free market actors think is the right level, you cannot price anything else. And so the debate at the Bank of Japan Policy Board actually needs to be a very, very deep and very, very fundamental one. It's interesting, right, that, in one aspect, the Bank of Japan has actually been more or less successful in exiting its intervention, right, which is on the ETF purchases, right, where in 2020 the Bank of Japan still bought, almost 7.5%, of the equity, not 7.5%. I'm sorry, bought 7.5 trillion yen of ETFs, which is almost 2% of the market capitalization, right? Basically, since the beginning of last year, they basically have stopped to intervene in that, right? So, and the Nikkei hasn't crashed, So that's actually been a managed transition. But the bigger point is not about interest rate increases. The bigger point is, will Japan's credit markets, including the government debt market, will they be liberated and be handed back to the private sector? Once that happens, right, it's going to become more interesting. And it's very interesting. Correct me if I'm wrong, Sasaki-san. The Yoteritsu, the promised savings rate by insurance companies is now what? 0.2, 0.3%?
I'm not sure.
Okay,
it's
but so that's the big institutional investors, the insurance companies. What is the long-term savings product? What's the promised interest rate to investors? It's 0.3%. So that actually means that if the Bank of Japan were to let go, right, the moment yields increase above 0.3%, those institutional investors will start to buy. So actually, in my personal opinion, the risk of, oh my God, when the Bank of Japan lets the children free, when the Bank of Japan frees up and abandons yield curve control, all hell is going to break loose and we're going to have a crash in the JGB market. In my personal view, given the savings surplus that Japan has, and given the promises that have been laid out, I actually think that the risk of a crash in the JGB market is very, very low, right? But that's at the core of what needs to happen. This is a massive, and it's not about the reasons for why this policy framework was put into place, because Japan was in a deflationary crisis, right? Now it's no longer in a deflationary crisis. You've got to change the regime. And it's not just about hiking interest rates. It's about changing the entire monetary and capital markets framework.
That provides an interesting thought for the next deep dive. Looking at the whole capital markets framework.
That's not a deep dive, that's a wormhole.
Yes, Yoda-san, please.
最初的メンバーof the FCCJ. Thank you, Sasaki-san, and thank you, Koll-san. It woke me up this morning. But I remember in the past, when the governor of Bank of Japan, or Japanese finance minister, announced the weak yen is too fast, it gave effect. But I'm not sure, did this time, did it give effect to the monetary market? That's, and also, maybe you are told already, how low do you think again it will go, and how weak yen give effect to Japanese, what the segment of Japanese, the stock market? Thank you.
So, how low will it go, and what will be the impact on the market? Just a quick comments on.
I think it's a bit difficult to say how much higher dollar yen and how low yen against the dollar, because if they are parabolic movement, it's really difficult to say. So it can go much higher if the Japanese government or policy doesn't do anything. Anyway, the yen is now in real terms the lowest in 50 years. So there's no precedent example to see this level is the next target, this level is next target. It's already the weakest in 50 years. So honestly speaking, it's a bit difficult to say. And in terms of the sector, it's obviously positive for the company who has an exposure in foreign countries, because their revenue is just keep going higher and higher in yen terms. But it's severely negative for the company relies on the domestic markets.
Okay.
So it's interesting, right? And I think, you know, Sasaki-san put the finger on that. We are in unprecedented territory, right? And the unprecedented territory is not because of the cyclical deviation of monetary policy, right, which we talked about. But the real unprecedented gendoryoku, right, the real underlying force, yeah, is the fact that the structural change in Japan's balance of payments has actually occurred, right? And so as a result of that, I mean, the idea that Japan is going to be running a trade surplus of 3-4% of GDP, it's a safe bet to assume that that will never happen again, right? So as a result of that, the structure and the transmission mechanism of the weak yen, right, has actually changed, you know, quite fundamentally, right? Now, the impact on the stock market is very cool, right? Listed companies, 60% of their money is made by selling overseas. So there's no question that for listed companies, right, the weak yen is a positive. For every 10 yen of yen weakness, Japanese listed companies' profits go up by about 8 or 9 percentage points. Now, the Chusho Kigyo, the belly of the economy out in Yamanaka, right, or out in Aichiken, it's a very different story because that's the cost push that actually hurts, right? So ironically, I think that the correlation between the yen weakening and the Japanese stock market actually doing well, I think that that correlation is likely to stay in place, right? Of course, Wall Street is not allowed to crash, right? That's very important.
Okay. Well, we're about out of time. Thank you very much. Tourism was touched on very briefly. I mean, it does seem that Japan is missing a huge opportunity here, technically speaking, for hordes of tourists to come in again and start spending money on Japanese consumer goods and so on. But presumably it's not going to happen because of COVID or...
Yeah, actually, I completely agree with Jesper. Maybe the reasonable solution at this moment to stop the yen depreciation is open up the border. Yeah, this is one of the reasons why yen just continue to decline and doesn't stop. Once now before the COVID, as Jesper said, that 32 million people, tourists came to Japan in 1 year and spent 4.8 trillion yen, and that's all gone. But now the yen is much, much cheaper than that of in 2019. So once we open up the border, more people, more tourists will come, and then they will buy yen. So I think that's the reasonable short-term solution, to open up the border.
And look, this is the key point, right? I mean, to get an inflection, right now the trend, I mean, this is not exactly, I mean, 6 months ago, this would have been a very radical, you know, oh my God, you're crazy discussion, right? Now, you know, I mean, it's more or less consensus, right? You know, because of the fundamentals that we talked about, right? So the question is, who's going to be the marginal buyer? Where does the new buyer come from, right? People selling yen, buying dollars, there's plenty of them. But where's going to be that agent that actually switches it, right? And, you know, fine, Anthony is very keen to get the government involved and start intervening, which I think is a low probability because, as I said, for reverse intervention, for Japan to reduce its dollar holdings, they would actually need the agreement from the Federal Reserve, right? From the Treasury, right? From America, and America, you know, is very, very much interested in a strong dollar. So, who's going to be the most credible and most tangible marginal buyer that I can actually mobilize? Well, I could mobilize, right, some of my friends in the asset management community, right, which is what Sasaki-san did very skillfully when that was his job, to intervene in currency markets. And he's always very humble. But at the time, you know, when this was the other problem, right, when the yen was too strong, Japan was very, very good at persuading some of the Asian sovereign wealth funds, right, to actually commit, right, to buy, you know, the other way. So it's very, very interesting to see that. This is not a conspiracy theory, this is just the way the real world operates, right? So could you mobilize sovereign wealth funds, which are longer-term investors? Could they become those marginal buyers who actually commit to Japan, right? Because there is deep value on a 5 to 10-year view, the fact that the stock market is cheap, the fact that real estate markets are cheap, the fact that labor is cheap is going to be unlocked. So sovereign wealth fund communication from Japan's policy leadership, and that's the MOF and the Bank of Japan, as well as to some extent METI, that's, I think something that if I were Mr. Kishida, that I would want to mobilize very, very aggressively. Buy my new capitalism, right? Is what he would have to do. But then the most tangible one is like, look, the next variant of COVID is even less harmful, hopefully, than Omicron was. We can open the borders and you get net marginal buying from global tourists coming through.
Okay, so Mr. Prime Minister, if you're watching, please open the borders. Okay, well, we are up against time now. Thank you very much. It's been, I think, personally, a fascinating discussion and provides definitely food for future thought, and we will follow up. So thank you very much to both of our speakers. Thank you, Sasaki-san. Good to see you back again. Don't let it happen again that you stay away for so long. We're going to give you a 1-year honorary membership. Is it here? Sorry, so it is. Even as I speak, there it is. A 1-year honorary membership. Thank you very much. Jesper already has his honorary membership, I think. So thank you again to the speakers. Very well, good, informed debate and very interesting debate. Very well presented. Thank you very much.
Thank you.
Thank you very much. Thank you.